With the price of oil pushing through 130 US dollars per barrel, there's a debate raging in the markets currently as to who's to blame for the elevated levels in the price of oil. Is it a normal supply and demand relationship, or is it speculators that are in essence manipulating the price of oil? I thought it might be instructive today to take a look at the debate and ultimately decide what the consequences are for investors in the commodity space. There's two main theories when it comes to impacts or effects on the price of oil. People in the first camp would suggest that the production of oil has peaked. So the peak oil theory would essentially say that the world is consuming more and more oil every day. Emerging market economies are moving from a realm of small-scale users of oil to larger-scale users in the future. And while that is happening, at the same time, the supply of oil is dropping and perhaps precipitously. The second major impact, or second major theory that people have regarding the price of oil these days is that speculators and investors are essentially hoarding commodities of all sorts, but oil in particular, through the purchase of futures contracts, and that impact has effectively driven up the price of oil beyond what the traditional supply and demand relationship would suggest, making it more expensive for everybody that drives a car and heats their home and whatnot. The volume of futures contracts that have been traded in terms of oil has more than tripled since 2004. And if you look at the dollars that investors have allocated towards commodities, it's up from 13 billion 5 years ago to over 260 billion today. So the question really facing the markets at this point is, does that financial participation in the commodity space represent speculation, or does it represent manipulation of some sort? Anytime there's a degree of speculation or speculative orientation towards an asset class, the volatility is likely to be dramatically greater than it was when it was simply based on the demand and supply relationship. So the existence now of speculators in the oil market, I think, will create pretty dramatic volatility over the next little while, especially if oil does start to drop in price in relation to cyclical pressures. It's certainly easy to foresee a drop in price based on the slowing of the global economy, for example. And we have seen demand for gasoline, in particular in the US, drop over the last little while in response to higher prices. So if we've seen a buildup in speculative presence in this commodity over the last 6 to 12 months, and that's responsible partially for the doubling in prices, it could also be responsible for a fairly dramatic reversal if and when the price starts to decline. What does increased volatility in the overall price of oil mean? Well, it doesn't necessarily mean that people shouldn't have that exposure in their portfolios, and it doesn't mean that it's not appropriate for them to have some degree of exposure to the asset class. It does mean that people will need to be aware of the possibility for increased volatility in that asset class over the course of the next number of years. And it means that they'll have to have the appropriate risk tolerance and time horizon if they're going to attain the objectives in their investment portfolio.